today's webinar on demystifying private equity valuation. Is there a better way? I'm Michel Degosciu, and I would like to welcome Jürg Burkhard from LGT Capital Partners. He is principal at LGT Capital Partners. Jürg will start with the webinar. He will give a short introduction to LGT and how they use private equity data to analyze performance of private equity investments and how they benchmark private equity investments. After that, I will then give an overview of LPX, how our indices are constructed and how our data and indices can be used to benchmark and to value private equity investments. So if you have any questions, please feel free to ask them or to write them to us. There is an ask and question model on your screen. You can use that. So I will try to answer them, or Jürg will try to answer them during the webinar. However, there will be also a Q&A session at the end of the webinar in case there are some open or remaining questions. Yeah, and now I would like to hand over to Jürg. Yeah, the floor is yours, Jürg.
Yeah, I feel the pressure. Yeah, thank you, Michel. Yes, my role at LGT Capital Partners, maybe it's interesting to know, I'm heading risk management and portfolio construction for the private markets business. Actually, me as a person, maybe worthwhile to mention, I have 5 daughters, so maybe not a surprise, I ended up in risk management. Today, actually, maybe the story behind the webinar, in a way, is as often it's meaning we're having quite a number of clients and partners, and we're having the partners of ours need to measure their performance as we do, and actually we were, as it happens actually quite often now, we were contacted by one of our very important and sophisticated partners that started the discussion and realized that's a repeating topic, and that's why actually we started to do a little bit more work than usual. I think I know also that at least a person from this partner is listening to us. So hello, Mr. Okshe, maybe Mr. Gaupel also. But we actually felt it took wider interest and probably in some aspects in the interest of the industry. So we'll be talking about methods and data, just to be very clear at the beginning. So diving into the material here, Capital Partners, again, it's us, 85 billion AUM, yeah, growing number of staff, but the important element, maybe below important for your context, is we're a specialist in private markets. All areas there, private equity, mostly private debt, infrastructure, real estate, and we're also a specialist on multi-asset and alternatives in general, also liquid ones. Multi-asset is important, meaning constructing multi-asset portfolios. I would see in terms of methods and data, there's a lot of parallels to what we discussed today. Oh, that goes now very fast. Huh? This is how slow. In private equity practice, we will mostly, at least I will refer to private equity, I guess, throughout the presentation. It's close to 50 billion we have under management in private equities, some 300-400 clients, and more than 300 professionals. The track record, that's now not really referring or focusing on our effort or achievement. I will come back to that. In terms of what we expect at least 5% more than in public equity. Quite often we formulate a goal of, in this manner, but there is many ways of formulating one's goal, or depending on the client investors, how we formulate goals. So getting more closer to the topic, what is a benchmark? And do we always need a benchmark? A benchmark, I would say, is a standard for measuring or measuring in general or judging other things of the same type. They can be market-based, inflation-related. It can also be absolute return targets, as you might know. Other possibilities are also there. Do we need a benchmark? I would say yes, as long as we have an objective, meaning objective for our investments. For example, even if you have an absolute benchmark, we still need to define a strategy how to achieve the target, the benchmark. We need to then measure actually the performance of the strategy and its components. Similar, we need to define or have a process, and we need to measure the value add or steps and tasks when we execute, actually. I think the focus should always be on the objective, or not to be just to tell somebody that he was bad or weak, or that I was good or very good, and why and how, but actually to learn and improve, to actually separate luck from skill. We're all paid just to take or make good investment decisions, so we should really also focus on measuring the quality of our investment decisions, I put it this way. I think one of the most important elements to understand is actually that when we choose or think about choosing data methods, it always starts with the objective and the purpose. And depending on the purpose, we may choose different methods and also the different data. I will come back to that. The problem with executing is, as you might all know, and that's probably why you have also dialed in here, that benchmarking exercise may be easily misleading, unfair, or irrelevant if methods or data are flawed. Seeing then all the difficulties which are around, especially for benchmarking private equity portfolio, it's probably also understandable that people come to the conclusion that maybe one should not benchmark at all. It's just too difficult, or it becomes useless, etc. We'll comment a little bit on that, or it should become obvious. Important, in my eyes, is also it's not only a data crunching exercise. A governance structure is very important. So you can ask yourself, should a portfolio manager actually be allowed to measure and judge his own performance, or should that be made or done by an independent team or function? At least I think one should carefully think about that. When choosing methods and data for benchmarking, I think it's important also to start with stylized facts about private equity returns or private market returns, and related to that also risks. So I think there is a wide agreement and also our experience. You can expect on average high returns in private equity, but more importantly, there is a high dispersion of returns. So the distance between good and bad is very large. So there's a higher impact of luck or skill. It's more important to discriminate among luck and skill. The good thing is also that it's not only the dispersion is higher, but also the so-called persistence. So if a fund manager has delivered a good performance, the likelihood is rather high that he will also deliver a good performance going forward. So skill seems to be very important in private equity, a precise selection, even more paramount, but also more promising than in other asset classes. In order to not confuse, when I say high dispersion, this doesn't mean high volatility. Dispersion is a measure in the cross-section, so it's a difference between bad and good, and it's not a variation along the time axis, what normally is referred to when we talk about volatility. I say that because we will see volatility is actually lower than in other asset classes. But related to that, in general, I would say in private equity, private markets, you would see lower risk or risk measures. You see here certain correlations. I know one can criticize that. I will come a little bit also to this point. But it's important to acknowledge actually a benchmark, a chosen benchmark should also show these type of return and the risk characteristics, or in a way, the same, as close as possible to actually the asset class. So if I will come back to that, I will explain that a little bit better. Here you see that the returns, actually expected returns according to our approaches and models in the firm for different sub-strategies within private equity, private market. You see, for example, that EBITDA growth has a big impact on the return expectation, also the historic data, right? So operational improvements probably are very key amongst other things. So in a way, you could also benchmark, right, operational improvements of your portfolio versus a market, etc. But in general, it's just important to align the benchmark to such characteristics. Next one is actually when we add to a 50-50 portfolio some multi-alternatives. There's a lot of private market. Higher allocations to the multi-alternative actually increases the return and lowers the risk. And again, I would just emphasize that a benchmark who is not having these properties, in my eyes, is questionable. Next one is crisis resistance, right? You see to the left, the bigger crisis, the great financial crisis, one of our strategist products. I would say big crisis, private equity loses half as compared to public equity 6 months later, in very simple words. Small crisis, like to the right, it's not like COVID, a small crisis in general, but in terms of economic development, financial markets, it was not so bad, actually, not so heavy. Actually, in smaller crises, private equity might actually not lose at all, or the opposite. Here is not so important what portfolio I show versus MSCI. I think it's typical for private equity. Over the long term, compounding effect lead to really a huge difference versus, for example, public equity. Why is this relevant? Again, I'm hitting now against the same issue from very different sides. So, meaning, when I look how private equity, private market is benchmarked or similar approaches used, very often actually the high return potential is ignored. And here you see what this means in the long term. Actually, I would also say that fundamental mathematical logic is often ignored. Like when the horizon grows and you can expect a higher return, that's just now a statistical truth. The longer the horizon, the more statistically dominant will return advantages become versus risk measures, as risk grows with square root of time with a growing horizon, but returns exponentially or depending on how you norm it linearly. So the longer horizon, the more dominant are just return differentials. And therefore just then say, okay, I ignore the high return potential for private equity. And then maybe I also use, like, take public equity and calibrate the risk measures accordingly, meaning a higher volatility, higher correlations. I would even say overstated risk measures. I would say that's a very flawed approach. It's actually really something you should avoid in general. Meaning calibrating risk measures in the short term, high frequent data, and then just extrapolate it to the long term is flawed per se. And in general, I would say, but it's very bad for a long term asset class like private equity, which you then really squeeze into an approach of short termism. And then, of course, use an optimizer, and then you will end up with just too low weights. Here can be quick. Again, like the outperformance is also consistent across time. Over time, you see it to the left, Cambridge associate data, public data, depending on the time when you invest. And to the right, again, it's just comparing the growth of public benchmarks versus private equity portfolios. Not important which portfolio, if it's from LGT Capital Partners or not, it's just what you see very broadly. You just buy actually higher growth. You often pay less for it in terms of valuation, and operational value creation is much more important. Anyway, what I want to say is you just have very different, especially long-term risk and return drivers, and you benchmarks should acknowledge that. Benchmarking now, judging a single fund or one's own fund selection capabilities. So the question is, am I a good selector if I actually choose, or if every second fund in my portfolio is top quartile and the rest is average, right? Meaning, if you analyze a fund-to-fund approach, or want to know how this ranks within a sample of funds, doing this just ignores basic statistic principle. I will explain that in a second. What is also important to understand is the more moving a target is, the larger is the impact of luck, or in other words, a larger fund-to-fund, the larger number of funds is needed to reveal the real performance of a selection process or approach. So Oliver Gottschalk, the well-known professor in buyout performance, researcher in buyout performance, also professor, has actually addressed the topic. It was quite common in private equity to say, hey, why is everybody top quartile? Probably 75% of the funds claim they're top quartile. So are these guys really cheating? Actually, they're not, right? If you give them a little bit of freedom choosing the data provider, the benchmark, and maybe jiggle around a little, play around a little bit with the vintage year, which is not cheating, I would say. There's different ways of defining a vintage year. Actually, it's 77% which can claim to be top quartile. I was too quick now, sorry. So here a small simulation. Actually, what you see is the distribution. This blue wide area is the sample of funds. You have taken one vintage year and actually chose the performance frequency, if you will, a smooth histogram. And then we actually say, okay, let's now select randomly 10 funds or 100 funds. This gives you the two narrow frequency distributions, the blue ones, right? And then we say, let's do that now for a good selector, which actually has a top quartile hit ratio 40%. So average performance a bit higher, right? So here you can actually see, the monkey, the random selection converges to the average performance with the growing number of funds selected. And actually the good selector with a 40% top quartile hit ratio, also the yellow curves. So if you take the 100 funds, which is the more narrow curve, the probability that the good selector ends up in the top quartile of the funds, not the fund of funds, is actually zero, converging at least to zero, right? It's just 10 funds, he can be lucky and still end there. Actually, even the monkey can be very lucky with 10 funds and still end in the top quartile fund. So actually we need a large number of funds to reveal the selection capabilities. And very important, we need to understand what we compare, right? Not that I've seen that quite sometimes. Fund of fund performance against a sample of funds completely flawed if you don't consider or not conscious about what you're doing here. So just a few keywords here, being mindful of time. It's important when you want to measure fund selection capabilities that you really look through to fund of fund. Useful measures, for example, are quartile hit ratios. You can also think about Gini type of curves as explained to the right. or you can do a monkey benchmarking exercise. You have a fund of fund, quite good performance, and then you can ask yourself, okay, what is the probability if that the monkey would achieve such a performance? If the probability is very low, there's quite some evidence that we have a good selection in front of us. In general, I would say vendor-based benchmarks and data is a bit tricky to be used to compare or benchmark a single fund against it. In general, vintage year is important to account for. If you don't do it, actually you ignore the J curve as an example. For aggregate data or more like mature portfolios in the long run, reinvesting, actually it's a different story. You can use aggregate data. Here I summarized a few pitfalls and problems, but actually I would propose not to go really through them, as I know Michel will talk about many things. It's just a question of, like, there is a lot of data flaws and biases around, etc. But you can, I think it's also self-explanatory. You can really read through these things here. Maybe just a word about the stale pricing problem. So if it's private equity is not seeing evaluations in every second or even days, it's a stale, it's a slow process, reporting process. So it's argued, okay, the stale pricing, actually it's an understated volatility, which results understated correlation. Some are proposing to use certain statistic techniques to correct for it. Unsmoothing techniques make it actually more volatile. I'm not a big fan of it. I have some explanation here. One of the easy ones, not statistical, is just what we show in the balance sheet is not smooth, so or unsmooth. So why should we do it? The rest is also, I think, statistically quite a lot of problems around unsmoothing. If you want to do something, and what we are doing is actually factor models where factor are driving the performance and make returns a bit less sustainable, in simple words. The do's and don'ts of benchmark choice. Again, it depends on the purpose. As an example, if you compare private equity against public equity, quite some of probably listeners want to know or have the mandate to beat public equity. And if you do that, you can use public market equivalent. You apply the cash flows of your private equity portfolio to a public index of choice. So the actually effect of not controlled cash flows or not controllable cash flows is taken out, and you actually consider the opportunity costs, and based on that you can really say then, okay, would I be better off now if you would have invested in public markets, or I'm quite fine with private equity. If you do a lot of this sampling based measurement I just went through in the example, I think you can really also go to vendors and filter and customize the data. Even though there's a lot of problems with data, Michel will explain, and actually filtering quickly leads to samples which are becoming too small. It's not easy and straightforward to construct time series. And I would say for some purposes like SCA, strategic asset allocation, or risk models, risk calibration, but also measuring a broader mature private equity portfolio in the long term against the private equity market, in my eyes, the best choice is LPX NAV data. And why this is the case, as Michel will tell you. By the way, also maybe listed private equity has some nice features, and LPX is also having an index, or a whole family of indexes there. Listed private equity portfolios have solved a lot of problems for private equity investors: cash management, due diligence costs, tax, a lot of costs and frictions already incorporated, and then actually the performance is after all these elements. For example, it's not giving you the whole answer, but part of the answer. If you wonder a little bit, if you benchmark your portfolio management, you can look compare your gross return numbers versus your net return numbers or net, because the difference is impacted by portfolio management. And this, the private equity, for example, in that regard is also, you can see it as net after cash management costs, which are normally not covered when you, for a typical private equity investor doing his benchmark exercise. Here, a quick rating exercise where we, together also with our key partner I mentioned, went through a number of quality criteria for a benchmark. And the outcome of that was actually LPX and NAV is the most promising, I would say, provider in terms of data and methods and concepts, right? So there you can really, you can construct time series and use these time series to calibrate your return expectations and the risk measures. But this is now, I think, topic of Michel. He will explain a bit more why LPX NAV is for certain purposes really well suited, probably best choice in my eyes, and also that's how we use it.
Yeah, thank you very much, Jürg. That was very interesting. So some good insights for us, and this also leads now to our poll. So before I start with my part, we have a quick poll for the audience, and this is basically an update of the paper from Northern Trust. This is already 10 years ago. So the question is, which benchmark do you currently use? So we have several options here to choose from. So either a market index, this can be a small cap index or any other equity index. And what we have seen, and what also Jürg has mentioned, that in some cases you add then a premium to this market index. So this could be one way to benchmark your investments. It could be a private equity composite. So answer B, it's slightly incorrect. It should say private equity composite, so which is basically a data from typical private equity fund, closed-end private equity funds. The third option is simply an absolute return figure. Then you might use another benchmark, or there is no benchmark that you currently use. And just one question for you, Jürg, what do you currently use in your portfolio, or to benchmark your
I would say A and B most often, but in a way all of them. Depends also on the clients and partners. Yeah.
Sure. Okay. So I think we wait maybe a few more seconds, because I see people are still voting. And then there will be a second poll right after that. Okay, people are still voting, so maybe a few more.
Difficult question, actually.
Okay, so let's see the answers. That's interesting. You saw still 19% are using a market index, then private equity composite a third, absolute return 14%. That's interesting, because when I remember correctly, Northern Trust had around 2% only using absolute returns, other 19%, and no benchmark. I don't see the answer. 14%. Maybe I just click back to the result from Northern Trust. So they have 2% used absolute amount, 48% public market index. So this has slightly changed obviously, over the last 10 years. So, and now quickly, the other poll, that's should be a quick one. Would you be interested in index data? So which means aggregated data in general, or on single investment company data, which means valuation and data on a single portfolio investment of a private equity company. So either index data, so aggregated data, or investment company data, or both. Are the options here.
Interesting results, meaning when I look into my matrix where I try to show, okay, first of all, what you want to measure, and depending on that, which benchmark or data provider is how well suited. Meaning if you see in the red cells, what I would really not actually advise to do, this is mostly using public equity, also listed private equity, to benchmark private equity, especially in a SAA, also strategic asset allocation, optimization, return risk optimization, or for risk models and calibrations.
No,
I think this leads to understating return and overstating risks, and yeah, that's what I normally advise against.
Okay, so let's have a look at the results here. Index data, 13%, investment company data, 30%, and both 56%. So that's good to know for us. So thank you very much for answering that. That's a very good feedback for us. And now I will also come back to those answers because we can actually cover both of that. We have a slightly biased to index data, but we have also data on investment company data. So let me show you what we do at LPX. So for those that don't know LPX yet, LPX was founded in 2004, and we started and published the very first private equity index at that time. That was in 2004, which measures the performance of private equity companies. And we launched the very first index at that time. It was called the LPX 50 index. So it includes 50 private equity companies that are listed on the stock exchange. And those indices are used for various purposes. It can be used as an underlying for an exchange traded fund. It can be used for benchmarking purposes, but it can also be used to measure risk and return in of private equity and include that in an asset allocation tool. As you can use in a similar way as that you use other indices from other asset classes. So that's a short summary of what we are doing. I would say we are a data-driven company because apart from the private equity stocks, we also analyze and calculate the underlying investments, and I will come to that in a minute. But we are really a data and research specialist in alternative assets. When it comes to benchmarking and valuation, I mean, I would like to differentiate between limited partners and general partners. I mean, there's certainly an overlap, so both need to track the performance of private equity against a relevant peer, either because they would like to know how did my fund investments perform against the market, or as a standpoint from the general partner. General partner would like to know, well, how good are my funds performing against the general market, and how can I use an outperformance to market my funds, to market and sell my investment and management capabilities, and use it in a marketing tool. So at the end of the day, they have similar, or they can use the similar data set, but the approach and the aim difference, of course. In the meantime, also from the compliance and regulator perspective, what we see when we talk to pension funds or insurance companies, they have also more pressure to come up with a reliable data set when they compare the investments and when they make announcements or pitches, or when they would like to know what is the value of my private equity portfolio. In the meantime, we see more and more pressure from the regulatory side and the compliance side to come up with an appropriate and measurable index or benchmark that is valuing the underlying investment portfolio adequately. So there are several reasons why you should use a benchmark, why you should value on a frequent basis your portfolio. And then the question is, how should those benchmark be set up? So of course the benchmark and the data set that is used for the benchmark, be it on an aggregate basis or be it on a single company level basis, should be transparent. You should know what is included in a data set, and especially in the benchmark, you should know what is the weighting, what is the composition, and it should be measurable. It should be updated on a frequent basis, so not only once per year, also not only once every 6 months, at least quarterly, and ideally you also have data points between those quarterly updates, and how we do that I will show you in a second. It should be appropriate. I think that's one of the most important points, which means it should reflect the underlying investment characteristics of private equity. So it should in some way be correlated with private equity investments. And of course, you should know in advance and be able to specify in advance. This sounds simple. However, in private markets, it's not always the case. And then, when we look at the typical drawbacks of existing benchmarks, I mean, one problem is the so-called self-reporting bias. So in many cases, the data is reported by general partners themselves. So they provide the data on their investments. However, as you know, there is some conflict of interest there. So which data should a manager provide? Who is tracking whether this data is correct or not? And then you typically have a time lag. And there is typically also not an independent auditor. Of course, private equity funds are audited, but it's not the same audit as you know from other markets, from other asset classes. So that are typical drawbacks of private equity benchmarks, private market benchmarks. And I would like to show you how you could use our data to overcome those type of drawbacks. Commonly used benchmarks, as we have seen at the poll a few minutes ago, many still use public market index. Some still use absolute amounts, and of course, private equity composites, so which is data from private equity funds, is also used. However, there are some drawbacks, and the flaws that I just mentioned at the slide before cannot be overcome with any of those currently used benchmarks or valuation tools, let's say it. And the most important conflict is between, you see it here, between whether a benchmark is measurable or whether it's appropriate. So of course, the cash flow data of private equity funds, of closed-end private equity funds, is appropriate. It's reflecting the underlying investments, it's reflecting the underlying economics and how the asset class performs. However, it's not measurable. When you think about how you measure the performance of stock market investment or the performance of a bond investment, there is no question that this data is updated on a daily basis, sometimes on a real-time basis every second. Whereas in private equity, it's still common that you have an update maybe once per quarter for the large funds, for the smaller and not so known funds, sometimes only once per year. So there is this conflict of interest, conflict of objectives between whether it's measurable or whether it's appropriate. And as you know, a public market index is measurable, it's transparent, it's specified in advance and so on, but it's not appropriate. A small cap index might be some way correlated to private markets, but it's certainly not an appropriate index to use it. An absolute amount is also very, very easy to use in an asset allocation or performance tool. However, it's not, in our opinion, not appropriate. So how do we solve this issue? So we are, with our data set, able to have, on the one hand side, an appropriate index, appropriate data, and on the other side, data that is measurable and updated on a frequent basis. Our data is based on companies that are regulated, that use generally accepted reporting standards, and the data is updated on a regular basis and frequent basis, and it comes from independent and public sources. So the question is, how do we do that? It's a very, when you see it, it's a very simple trick. We focus on private equity companies that are listed on the stock exchange. Typically, when you think about a private equity fund, about the wrapper of this portfolio, this is typically a limited partnership structure, a closed-end fund, and this is typically not listed on the stock exchange for obvious reasons. However, there are around 100 companies on a global scale of private equity companies that are listed on the stock exchange, and where you can then get access to the composition, to the investment portfolio of those companies. And because they are listed on the stock exchange, you know where they invest in, you know the valuation, you know latest investments, latest exits, and you have very high reporting standards. Because they're listed on the stock exchange, they have to fulfill the criteria and the listing rules from regulated markets. So this sounds simple. However, you have to go through those portfolio companies to the reports, read the reports, read not only the annual reports, but also updates between the reporting dates, to incorporate this in the database, and to make it transparent and standardize the data, so that people are able, or investors are able, to use the data to benchmark either single portfolio companies or on aggregate level and portfolio. So that's how we approach, how we get our data. To give you an easy example, one investment is Visma. It's investment by LGT Capital Trust. They invested in 2008, and here you see the NAV, and the NAV in this case reflects nothing else than the valuation of that single investment. And when you have then the whole portfolio of, in this case, LGT Capital, then you have the NAV and the valuation of that private equity portfolio, which is traded on the stock exchange. And we use that type of data to construct an index. So you see here, the gray line are the official NAVs as published by the company. So you have already a quarterly update in most cases. However, between those official reporting dates, you can have some news. Typically, because the companies are listed on the stock exchange, they have to announce a new investment, they have to announce a trade sale, an IPO of one of their portfolio companies. They update revaluations in case a new investor comes in, and so on. So between those official reporting dates, we use that data to update our own valuation tools and data set to come up with a more updated and have made, let's say, an early indication of the development of private equity in general. So that's, in a nutshell, how we construct, how we collect, and then transform the data into an index. However, there's also data on a single company level available. Then when we construct indices, benchmarking data, we have several indices. We have global indices, we have a style index measuring buyout and venture. I will show you the characteristics of buyout and venture in a minute, and then also focusing on different subsegments of that asset class. And because we have that data in a standardized way, we are also able to customize indices to reflect individual portfolio characteristics. That's the very nice thing when you have regulated and standardized data in this asset class. You are able really to customize not only regarding buyout and venture, also regarding regions, in order to reflect individual characteristics of an investor's portfolio. Then a question that often arises, is this really reflecting? So it has to be appropriate, which I mentioned before, it's a very important point. So because we know where the companies invest, we also know what was the investment style. Was it a buyout deal? Was it a venture deal? Was it a growth deal? And we also know in which sectors they invested in. So we have a sector allocation regarding the GICS codes. You see it here. So we think that this is reflecting the underlying investment characteristics quite well. However, if you're interested, I'm happy to give you more detailed information on that in a personal meeting or conversation. Also regarding vintage years, also this we are of course able to track because we know when the investments were made. So we have also the vintage year allocation of the portfolio, and this can also be sliced down to individual portfolios. In the next 3 to 4 slides, I would like to show you some performance characteristics. So this is now measuring the underlying performance, the net asset value of private equity portfolios, of private equity portfolios that are listed on the stock exchange. But important to mention, it's not the stock price that we are tracking here, it's the underlying performance of the net asset value, of the valuation of those companies. Here, over the past 10 years, we have here an annualized return of 9.5%. Over the last 3 years, it was around 11% per year, so that are annualized figures. And I have now compared this to a small cap index because, as I know that many investors, many limited partnerships are using a small cap index to measure the performance. As you can see here, performance-wise, it's different. Well, when you look at the chart, maybe it doesn't look that different, but when you look at the numbers, it is different. 10 years, it's only 7.6%. Over the past 10 years, it's 10%. Over the past 2 years, it's minus 4.5% on an annualized basis. So there's a huge difference. And the most important difference is when you compare the volatility, so the risk. Our NAV data has a volatility of around 5%. When you take a small cap index, the volatility is around 16% on an annualized basis again. So here you already see, well, this is much more volatile than what I would expect from a private equity portfolio. Then you see also the correlation number, it's only 0.26, which means private equity is correlated with a small cap index of only 0.26. So there's basically no correlation between those two asset classes. That's why we say a market index, a small cap index, it's easy to use, but it's definitely not appropriate to measure the risk and performance characteristics of private equity. And now when you compare buyout and venture, as you know, it's important to differentiate between those two subsegments. You see here again the development of the NAV index of buyout and venture. On the right hand side, the blue line is the venture index, and the turquoise line is the buyout index. And also here you see, well, there are some phases, some time spans where it's very similar development. However, especially in the last 12 to 18 months, there is a significant difference between buyout and venture. Buyout returned around 15% over the last 15 months, whereas venture returned minus 15% over the same time period. The economic reasons for that, I think, is clear. With the rising interest rate environments, venture capital investments, startup investments have to be written down because the discounted cash flows takes into account higher interest rates. So it shouldn't be a surprise. However, in the buyout market, the rising interest rate environment doesn't have that impact, because in the buyout market, we talk about EBITDA multiples, about sales multiples, and so on, so which is much more healthy as compared to the valuation of a venture capital investment. So, but again, here you see also difference between risk volatility. It's around 6% for buyout, and it's around 8.5% for venture capital. Also, that's something you would expect from that asset class. From venture is slightly more risky compared to buyout. And this is also reflected in our database. So then in addition to that, we're also able, of course, to have quarterly returns using our data. This is now going back to 2003. So our data goes back, almost, no, in the meantime, more than 20 years. So we have more than 20 years data here in our database. And this can be used as a daily time series, as a monthly, or as a quarterly time series. So this is in a nutshell how we construct the indices, what the results are of the indices. And just to summarize, I mean, one of the main advantages here is that we have a daily availability of the data. So you can use our data set in a similar way like you use time series data for equity investments, for stock market investments, or time series data for bond investment, and so on. So we can use the same tools and just input our database for benchmarking purposes on an aggregate index level. Then we have transparent data, and we have also data on the underlying investment company level. And because the companies are listed on stock exchange, it's much more reliable what they publish, because they have to fill some listing rules. They have to have an independent auditor. Self-reporting bias is almost impossible here, because then they would breach some listing rules in case they just report any misleading figures. And last but not least, our data is easily available. You can download it from Bloomberg, you can download it from Refinitiv or from other data vendors. Of course, you can also access it directly through our website, but it's much more easily available and can be handled in a much more easily way compared to other data sources. So, so summarizing, we are able with our data to help you to measure the performance of private equity or venture capital, but also to measure how individual portfolio companies are evaluated, and it's measurable and appropriate. So the conflict that we have seen with the other tools, we think we can solve that. And for those that have participated today, you can also download a sample data set. So just click here on bit.ly LPX nav, or scan the barcode here. Then you will get access to a sample set of our data. And we would also contact you by email in the next coming days, and also send you again the link. So if you don't have time to do it now, you will get that link in an email in the next coming days. So I mean, we can now have a short Q&A session. I mean, I don't see many questions right now. So if you have any open questions, just ask them now. There is one question. How often do you update your private equity indices? Well, the indices, as I mentioned, are updated on a daily basis, or calculated on a daily basis, and they are also uploaded to the various data vendors and also to our webpage on a daily basis. So every day you get a new value for the index and can use that in your tools. So it's a very, very straightforward process to update and access the indices. Then there's a second question: how do you collect your data? Well, that's a very good question. I mean, we collect the data, as I said, from private equity companies that are listed on the stock exchange. How do we access that? I mean, they are all listed, so you get access to the data. You don't have to ask them; they have to provide data, at least in their quarterly or annual reports, but between those dates, they have also to publish that. So we have a direct link to the companies. In some cases, there are some questions on the data, so we can clarify that. And then it's incorporate in our database, and then we apply or we make a standardization on the data. So we make sure that because the companies are listed and traded in different countries where maybe slightly different reporting rules apply, we make that transferable and standardize the data so that everybody can access this in an easy way and download it also in a very easy way. There's another question: how do you ensure reliability of data? It's also a very good question. Of course, we rely first of all on the data that is provided by the companies. However, because listing rules apply, those companies are audited by auditors, and the companies have to give adequate figures and data of their investments. What we of course do, we cross-check the data, so we make checks whether it's plausible what they are providing of the data. In some cases, we might make some adjustments. This might be the case if we see the valuation is far too high, or if we see that could also happen that in some cases two investors are invested into the same company, and then one private equity company is providing an update of an investment, and we know, well, there's another investor into the same company and they have not yet updated their valuation. So we can then use that to cross-check the data and reliability. And then, it's what we constantly do is to compare also the performance and risk figures of our data with other data sources. I mentioned, or I summarized this as private equity composites. So there are other data sources where then we can compare. And actually, we have done this. I can send this over. We have compared our data set with data set of other private equity data collectors, and we see a very high correlation in the underlying investments. Yes, there are no further questions coming in. So then, let me say thank you to Jürg. Thank you for your insights, and thank you for everyone who joined.
There is another question. Not sure, Michel, if you want to address or can address.
Sorry?
There was another question, I believe. If you still have time, are you seeing a trend for more PE companies to be listed, or is it declining?
Yeah, I just see it. Yeah, well, that's interesting. Over the past, well, we are tracking this universe of stocks since 2004, so almost 20 years. At that time, the total, just to give you a few numbers, at that time, the total market cap, the valuation of private equity companies that are listed on the stock exchange was around 50 billion. Currently, it's around 250 billion. So 5 times the value than 20 years ago. So there was a strong growth, not only in the number of companies, but also in the size of the companies that are listed on the stock exchange. Over the last couple of years, we have seen also some of the fund managers listed on the stock exchange. And of course, for several reasons, because they wanted to have a valuation of their company, to have maybe also an exit route for the founders of a private equity company, so for various reasons. However, what we have also seen over the last 20 years, when you have or valuations in the market that we currently see where the discount is very high. So when we see that the stock price of a private equity company is significantly lower than the valuation of that company, it's difficult to issue or to make an IPO of a private equity company. So that's why I assume that in the next, let's say, 12 to 18 months, we won't see many, if any, listings, IPOs of private equity companies, but mainly because the discount currently is too high for that. Regulatory burdens, is of course a burden, because when you are listed on the stock exchange, there are higher regulation rules, there are higher barriers to list that company. However, we see the main burden is the discount that we currently see. So now a very last question, and then I will finish. What other service LPX provides for alternative investments? Well, yeah, of course, beside the LPX NAV indices, we also do research on infrastructure companies. So we have a whole data set on infrastructure investments. Our data is used also for financial products as an underlying. So there are various ways to use our data, our services. Today are focused on the NAV data, but of course I'm happy to discuss any other services that we provide. So now, again, let me thank you for joining us today. And as I mentioned, I will contact you in the next coming days with some updates and the link to the sample set. Thank you very much and goodbye.